So we have all the results, and the best DCA is without any doubt the DCA. We often hear that DCA, dollar cost averaging, is the best way to invest over the long term, especially in a market as volatile as Bitcoin. But there's a question many investors ask themselves: how often should you do your DCA? Is it better to invest every day, every week, every month, or even every quarter? Or does it ultimately make no difference at all? Today, I decided to run a very simple test. I took Bitcoin's prices over the past 7 years and simulated 4 different investment strategies. In the end, the total amount invested is the same over the same time period on the same asset, Bitcoin. The only thing that changes is the frequency of the investment. I even ran another bonus experiment to see if we could beat DCA, but I'll tell you more about that at the end of the video. So, is DCA as robust as they say, regardless of the frequency? We'll find out right away. But first, let's set the basics. What exactly is DCA and why is this strategy so popular? DCA, for dollar cost averaging, is one of the simplest investment strategies, yet also one of the most powerful. The idea is very basic. Instead of investing a large sum all at once, which is called lump sum investing, you invest a fixed amount regularly. For example, you might invest every day or every 2 weeks or every month. And each time you invest, you put in the same amount of money, regardless of the asset's price. The goal really isn't to guess whether it's the right time to invest, but simply to follow a consistent plan over time. It's a somewhat automatic approach, and above all, it reduces stress. What's magical about this method is that it smooths out your purchase price over time. Sometimes you'll buy when the asset is expensive, sometimes you'll buy when it's cheap, but by investing regularly the same amount, you end up with a very balanced average price. Dollar cost averaging is particularly popular in the stock market, but also in more volatile markets like crypto, where prices can swing by dozens of percent in a single day. So instead of trying to predict these moves, DCA lets you gradually enter the market, thus reducing the risk of investing everything right before a potential drop. It's also a super accessible strategy. There's no need to be an expert, and there's no need to spend hours analyzing charts. Just set a budget, a frequency, and stick to it. Historically, it's clearly one of the most profitable investment strategies out there, and this has been proven in academic research. But is there a way to optimize your DCA? Does changing the frequency impact the final return? For example, is investing daily more effective than investing monthly? That's exactly what we're going to test right now with concrete numbers. And I'll explain the methodology. But first, tell me in the comments section, which DCA frequency do you think works best? I bet you won't guess which one comes out on top. And by the way, I see that more than 85% of you watching us haven't subscribed to the channel yet, so I'll give you 5 seconds to fix that. The goal is to compare different Bitcoin investment frequencies using the same total capital, the same test period, and the same transaction fees. We want to see if investing more often or less often has an impact on long-term performance. So here are the 4 scenarios we're testing today. The daily DCA, where we will invest $10 per day in Bitcoin. The weekly DCA, where we will invest $70 every week. The monthly DCA, $300 once a month, and the quarterly DCA, where we will invest $900 every quarter. For this test, I'll use the Upside platform to create a strategy. I'll use the Bitcoin price data from Binance. As you can see, we have the default fees enabled, and we'll start with the daily DCA. So I'll just type invest $10 every day. As simple as that. Our backtest period will be from August 2017 up until today, so that's 8 years. And this is a good test period because we went through different phases. We had bear markets, bull markets, stagnant phases. We also had the COVID crash. So we basically had a lot of cycles. All right, so we'll start with that. I'll launch the backtest and we'll see what we get. Let's go. As usual, this should take between 30 seconds to a minute to get the results. Okay, the backtest is over. Let's check the results. Okay, so over the last 8 years, the daily DCA would have made us invest roughly $29,000, and the final return would be 785%, with an annualized return of roughly 31%. 31.39% if we want to be accurate. and the max drawdown was minus 75%. Okay, so these metrics, total performance and the annualized return, will be our reference metrics to compare other frequencies. So let's now continue and we'll go on with the weekly DCA. So I'll just copy the strategy and I'll just change the rules. I'll say invest $70 every week and I'll start a new backtest and we'll see what we get. Okay, so for the weekly DCA, the program bought every Monday at midnight. So basically at the beginning of every week. Now here are the results for the weekly DCA. And as you can see, they are very, very similar. The total performance is 786. We had 785, so a tiny difference here. And the annualized return was 31.39, and here we have 31.4. So basically the same. So there is no difference at all between the daily DCA and the weekly DCA. That's good to know. Let's now then continue with the monthly DCA. Again, I'll copy the strategy and here I'll say invest $300 every month. And okay, let's see the results that we get. Once again, no difference. Total performance very roughly the same and the annualized return almost similar. We're still in the 31 point something% return per year. And this could be surprising because you might think that the daily DCA smooths out much better the entry price than a monthly DCA. But apparently, it doesn't matter. What's interesting is that the daily DCA required, it was 2,900 transactions, whereas the monthly DCA, we roughly only had to do 96 transactions, and in both cases, we get the same results. So by doing 30 times less transactions, we still get the same return and the same annual performance. Okay, let's now check the quarterly DCA. So that will be $900 every quarter. Let's check the results. Interesting. Here we get a slightly higher total performance with 834%, but when you check the annualized return, it's only slightly higher than the annualized return of the daily, weekly, and monthly DCA, barely 1% higher. We had 31.4% roughly on average. Here, it's 32. So again, these differences are minor and negligible. This slightly higher annualized return on the quarterly DCA might just be pure luck rather than a real statistical advantage. So what's the conclusion? On Bitcoin, historically, no matter if we did a daily, weekly, monthly, or quarterly DCA, it had no impact on the final result. Now, how do we explain that? Well, the extreme volatility and unpredictability of Bitcoin's price means buying more or less often evens out over time, because basically, no matter how often you buy, you're still going through the exact same cycles. Sometimes the daily DCA might be better over some short periods, while at other times the monthly DCA will allow you to buy right at the bottom. But over time, this all cancels out, because as long as you're going through the exact same price movements and the same cycles over a large enough number of cycles, you get the same results. And on crypto here, fees had no impact because they are percentage based on the amount of money that is invested at said frequency. So over this whole test period, in the end, we basically paid the same amount in fees, no matter the frequency. Now, I told you that I wanted to try a bonus experiment to see if we could beat DCA. So here is the strategy that I had in mind. Every month, we will set aside $300. And only when Bitcoin, the price of Bitcoin, is oversold on the daily chart, then we will invest all the money that we had set aside. And we will repeat this logic over time. So I phrased it exactly like that on Upside. I said set aside $300 every month. When the RSI goes below 30 on the daily chart, so that's when price is considered oversold, invest all the money you had set aside and repeat this logic over time. So as you may have noticed here, unlike DCA, there is a notion of market timing involved. We're basically trying to unload all the money we had set aside when price of Bitcoin is likely to be cheap. That means when the RSI has gone down significantly, which means price went down. So supposedly we're trying to buy at good prices. So let's test that and see how it performs. And while it's backtesting, we can clearly see that this kind of strategy is kind of similar to a buy the dip strategy. We set money aside and we wait for a big dip to happen. Basically, it would have bought like when price goes below 30 on the RSI, so it would buy here, then again then it would wait, keep money aside and buy again here as well as here, and like again here. So these are good prices to get in Bitcoin. They're very close to the bottom each time. Then buy again here. And yeah, basically historically, every time the RSI goes below 30, then here it would have caught the exact bottom. Same thing here, and even like again roughly here, and once again here. Oh, that must mean the backtest is ready. All right, so how good is buy the dip? Well, it's good. Actually, historically just as good as DCA, because the annualized return is like roughly the same. Though the risk with that kind of strategy is that since there is a notion of market timing involved, if you miss one of the opportunities, then this can greatly impact the performance, because as you can see, the total number of times that the strategy bought the dip was 24 times. So if you missed one of those times, it could actually hinder the performance. And this is also one of the things I wanted to mention about the quarterly DCA. There were so few transactions that basically the overall performance is tied to a small number of transactions. So if you miss one of them, it can significantly impact the performance. That's of course if you do things manually, because that's like totally something that Upside could automate. So all in all, what does that mean for you? Well, if you want to invest in Bitcoin, you do not need to overthink the frequency. Pick the one that suits your schedule and your reality. You like to watch the market every day and want to get a feel of being into the action? Well, then do the daily or weekly DCA. If you want to spend as little time as possible on this kind of investment strategy, then pick the monthly DCA or even the quarterly DCA. Just do not forget it. The key to a successful DCA really isn't in the frequency. It's in the consistency and discipline. That means sticking to the plan even when the markets go crazy. Tell me in the comment section if you will change your DCA frequency after watching this video, and which one you had been using up until now. Also, don't forget to like and subscribe, that will greatly help the channel. As for me, I'll see you in the next video. Bye.